at this point, markets have probably gotten too pessimistic on growth and too pessimistic on earnings. But I'd say like two, I think, main takeaways from the options market. One, on the more negative side, is that people are pricing for high volatility to stay around.
No recession, though.
But no recession. So we're not expecting recession as our core scenario. We think volatility will stay, just given kind of the growth uncertainty, the trade war headlines, that will likely persist going forward. So, what's been unusual in recent years is whenever we get a spike in vol, everyone plays for that quick normalization. You're not seeing that right now. So
it's pretty amazing because there have been people who said, we're already in a recession. I've seen that by December, we're already in a recession. And it's like,
how do you?
It was 2 months ago, we were Goldilocks forever. And how does that, I don't know how it changes so quickly. People want to be ahead of the curve. I guess, but
yes, that's not in the data. I think if you look at the
although there's some weakness, oil scares me. 46.
Oil scares us. I think the question is next year. Everyone expects deceleration, but is it so much deceleration that you tip into recession? We don't think so. But clearly, that's on everyone's mind.
Janelle, what they're going today? What? Give me 75 that they go 80, 100. What are they doing today?
We do think that they will increase today. And I think when we think that the uncertainty going to this meeting is higher. Economic data has been resilient, but certainly the softening, as you noted, and the flow through into financial conditions and the way it's been reflected in the yield curve creates a delicate balance for the Fed. I think what's important to remember is really where we are in the cycle. And if we think that longer term expectations 3% type level is neutral, then we have to remember that even with additional tightening, we're still doing it within an accommodative range. At the same time, though, I think we have to acknowledge that the Fed has to acknowledge what's happened in the markets. And so we would look for some change potentially in projections or even in its commentary to really reflect that and capture it.
So when the idea that we go between what Jamie Dimon said, being behind the curve and not normalizing quickly enough, or going a little bit too far like the Fed has done many times in the past, but never from such low levels. Do you think a quarter point doesn't make or break anything, does it? If they were to do a quarter and then really say, we're going to totally be data dependent here, we may or may not go at all next year. If they were to intimate that, would it be okay to go up another quarter? Or because the markets have definitely gotten a little nervous about what the Fed is. I think it's partly that. I mean, maybe it's China, maybe it's the slowdown, but there has been some consternation with what the Fed's been doing in the equity markets. Can they go another quarter and not kill things?
We think that they can. And again, it comes back to really where we are and that this is about getting to neutral, not being about tighter policy. We think the markets would welcome that. I think the risk is if they don't do that, it reflects that they see signs of increased weakening. And then there's also the risk they do get behind the ball and that the catch up, as we've seen it in prior cycles and in earlier times, is more significant and has more negative ramifications.
If I were Powell, I'd be like, God, I wish I was here when Bernanke and Yellen would. What are we doing this time? We're staying zero. Yeah, got any decisions to make? No, not really. We're staying at zero. This is a hard decision. This is something that could come years from now. You could go back and say, Powell they went too far. They let them, or wow, they got really behind. This is a much more not momentous, but if you go back to the crisis, obviously that was tough. But I guess it's always tough. But it seems like this is a period where you are definitely set up where you could make mistakes.
I think this is where the financial conditions, and as we watch that, and certainly the shape of the yield curve come into play. When we think about longer term rates, simplistically, we think about it reflecting growth and inflation. And so the risk is that when we look back and observe neutral, that we thought it was higher than it was. And so as the Fed impacts short-term rates, if we would see them tighten beyond what we really think that neutral level is, invert the yield curve and further restrict financial conditions, this is where it becomes problematic for the economy. And I think that's why, given what we've seen in 2.5s recently, the market's very focused on really where this neutral level is and what the shape of the curve looks like, and really what the flow through is then into financial conditions as we enter 2019, acknowledging some of the volatility around Brexit and trade and government shutdown that we've certainly seen.
And the transports and commodity prices. I saw copper yesterday. What does all that telling us? I mean, is inflation really a problem? Why raise rates if there's no inflation?
I agree with you. So, I agree with Janelle in that the Fed is most likely going to hike today, but I don't think they should. I don't think they should just because on balance, the risks of, we're talking about being too slow or too fast, the risks are not symmetric, right? If you get below the curve, we're still at 2% rates, right? There's a lot more on the upside that you can tighten if inflation gets out of control, which I don't think it will. But if you make a mistake and you tighten too fast and you push us into a recession, right, the risks of that is, I think, much more severe.
But would people freak out if the Fed decided not to raise today after it was essentially baked into the cake as recently as a couple of weeks ago?
I do think that we'll send the message that the economy is maybe weaker than expected, but it also tells you that the Fed is more proactive than expected, right? They're more willing to be ahead of the curve, I think, on the downside. But I think perversely, actually, what makes the Fed more likely to hike today is the fact that the president has been, pressuring them not to. And by doing so, the Fed, I think, will likely want to exert its independence.
You think there's going to be a political element to this?
Oh, absolutely. I think maybe they won't.
How many? Trump was. I mean, I'm not saying out of the mouth of babes, and he's a real estate guy, and he has a totally different reason why. But he was way ahead of all these other guys. He's Gunlack, all these geniuses of
years to not have higher.
I know he may have done it for all the. He may have said it for all the wrong reasons, but he was like the first one.